Good morning and welcome to the live stream. It is Wednesday. It's the last day of April, April 30th. And we've got some big news coming out of, I guess, whichever governmental agency measures GDP that I wanted to start off with and then go over a lot of earnings that have come out on this live stream. We'll take a look at where the markets are going today and what's been going on. We'll take a look at some stocks that announced to see how those companies are performing and seeing what kind of trends we're seeing in the market. We've had a year where we started strong. We had two rough months starting in February, going into April. We had a nice 6-day run. We had, I think, positive 6 days in a row starting last week. And even yesterday was a decent day. But I think today may be in the red. And the reason for that is that the GDP report came in and it came in negative territory. What that means is the economy contracted a little bit, 0.3%. The economy produced less gross domestic product. That's what GDP stands for, gross domestic product. So in general, it went down a bit. It was expected that it was going to come in at 0.3%. What's also interesting is that sequentially, meaning the quarter prior, which was Q4 of 2024 versus Q1 of 2025, the sequential change is minus 2.15%. So the economy contracted 2.5% quarter over quarter. So that's another way of looking at it. And so this is most definitely news that is it's bad news, and it's going to be processed as bad news because it could be the beginning of a strong recession, of a bad recession, or hopefully it's just like, hey, we're not even going to, qualify as a recession because the second quarter of 2025 is going to be positive. If the definition of a recession is 2 consecutive quarters of negative GDP, we got 1 in the books. So if we go 2 in the books, then we officially have qualified to call it a recession. So now we got 50% of the definition on the books. Now, if things can grow, we're going to be all right. So we'll see if things can be changed and what things can be changed at the U.S. government level, the Federal Reserve level, and where the economy just naturally goes. So that bit of news is making the stock market really worried. And that's why we're seeing the futures really come down. The NASDAQ's down 1.83%. Oil prices are down substantially. S&P is down and the Dow. So we're going to open in the negative in about 30 minutes. So that is going to be the story of the day. We have a lot of earnings, and we have huge earnings after the market closes today. So this might be, I'm not sure what's going to happen, but I'll tell you what I hope happens is we're going to have a bad day. But we have good earnings from Microsoft and Meta late today after the market closes. And then we have a decent day tomorrow and Friday. And if that happens, I'll be pretty much thinking, okay, we're not going to go down a whole lot, but we'll see. We could go down quite a bit. When we look at the market, we were beginning to kind of come back. You see this nice run here we went on. But what I'm afraid of is this recession talk is going to get us right back on this like negative trajectory, kind of following this as a line, and we kind of go down even further. hoping that's not the case, but we will see as we let the market trade day after day. So let me say good morning to everyone. Anthony Ferguson, good morning. Hope you're doing well. And Alta, good morning. Rotel and cheese. And let's see here, Anthony. The Fed has a habit of revising old GDP numbers. It does. It does once they get better data. Rotel and cheese. Yep. I can understand your point. I can understand your point. Let's see what happens. The market was pretty darn resilient, right? It went down hard, especially when we from April 2nd to April 8th. This was like pretty shocking. Like the market going down that fast was really concerning. Like, wow. I you know, I don't think well, I saw that during COVID, and I saw that during like times like I remember when the the um the towers in New York were crashed into by those airplanes, that terrorist attack. You saw it kind of like a big sell off where you saw this kind of behavior. But I'm like looking at it going, wait, there isn't like some big massive, collateral issue. So for it to sell off like that was really surprising and concerning. But then the market started to come back. Okay, that's good. And since then, it's up 14%. So that, if anything, enabled investors like myself who wanted more cash to sell out of some stocks and create more cash. And I'm glad I did so because I doubled my cash position this week. So I'm glad that I did so. And if you want to know the stocks that I buy or sell, I report it to paid members twice a week. Once on the weekends, I kind of go over everything that I bought and sold. And then today I'll be creating a short video, and I'll basically be talking about the stocks that I bought and sold Monday, Tuesday, and partially on Wednesday. So if you'd like to see that type of information, become a member, join. It's easy to do. And today we had somebody join, Yaz. I don't know. I don't think he's on. At least he hasn't said hello. If you're on, thank you for joining. And thank you, Anthony, for being a member. So we'll see how things go over the next, couple of days. I ended up yesterday at the end of the day, my portfolio got in the green. I was up 0.48%, which is good because, most super investors are in the red. And this updates real time. And I would basically be right here in fourth place. But I think the being in the black is going to be short lived because today the stock market's selling off. So I'll enjoy it until the market opens in 22 minutes. And we'll see when I can get back to the black. I'm sure I will. Stock investing is it's like, I'm going to use a sport as an analogy. And a little bit like baseball. And baseball might not be the most fun sport to watch, but I like it as an analogy because they have a 162 game schedule in a season. And then they have the playoffs. So you add playoffs, geez, that's like 170 plus games. Similar to like in a year of stock investing, geez, we've got like 200 plus days of trading. And you have some periods of time when, like in baseball, you have a losing streak and you get down and so forth. But even the best teams in baseball, in history, lost a lot of games. Like they win 100 games and lose 62 games. That's a really good season. But you lost 62 games. Yeah, but you won 100. So in stock investing, remember, some of these losing streaks, they're going to happen. And we just got to try to adapt, try to understand what's going on, try to understand where the opportunities are, what sectors are going to work because things have changed. Where, should an investor hold assets? And it's not an all or nothing proposition in my book. The whole concept of somebody cashing out, going into cash 100%, and then trying to go back in, it's just structurally really difficult, especially if you're carrying a big portfolio, millions of dollars, right? It's just technically, or, you know, you doing the trades, that's difficult to do. So it's really about changing your portfolio similar to, a garden or something that you have going, it's growing, and certain things are working just fine. All you need to do is just, observe them, maybe make a few small changes, and you're good to go. But certain parts of your garden are not doing well. Well, you got to take action. It's not about, just watch it, deplete to nothing. Maybe some sectors were really good 6 months ago. They look good 6 months ago. But today it's like, you know what? It's not looking good. Or, for an example, a company surprised me on their earnings, Chubb. And the surprise was a big departure to what I thought they were doing. And they were executing really well for a while. And then they surprised me and they executed very poorly. Their growth wasn't there. It's like head scratcher, like, okay, well, I need to sell some Chubb because that was a surprise. And I sell companies when, like, if I believe in a company, I think I got a really good discount. I think that they have a good story for the next year, 2 years, 5 years. And okay, I'm a buyer. But when something like that changes where, hey, the story changed or their execution really changed, I thought they were going to grow at 10%, 20%, and so forth. And they don't grow. It's like, whoa, okay, that changes my valuation. And then I take action. So I'm glad I built up some cash because now if stocks really sell off, I'll probably go on a buying spree. I think I can buy for a while because I think I have enough cash now to hold me until June, and then I've got some bonds that are gonna they're gonna um I'm gonna get the cash back on some bonds. Some bonds are gonna redeem is the right word, and I'm gonna get some more cash in June. So assuming that we're gonna have a nice sell off for a while, I've got cash to operate with, so that's good. Cool. So yeah, good luck finding a job, Anthony. And you know what? You sound like a positive minded person, man. To take it in stride, go look for a job and stay busy, maybe advance your skill set as an investor, man. Good job and good luck. All right, cool. So that's what's going on macro level. We've got about 19 people on the live stream. We're at 6:13 a.m. Pacific, so that's 9:13 Eastern. We went over the GDP data. Now, one thing I'm monitoring is bonds. The bond market, it's going everywhere. Geez, earlier today, most things were red, meaning that interest rates were falling, and that means that bond prices were rising. But now we see that long-term bonds, the bond price is going down, and the yields are going up. And intermediate bond terms, rates are going down, which bond prices are going up. And not a whole lot. I expected bigger numbers. With a report like that, you're going into recession, more investors want to move to bonds. I expected this to be red across the board. I expected bigger numbers of change, like 0.1, right? And we're not seeing that, which may be a tell. This may be that the market isn't as scared of that GDP report as I thought it would be. I thought that GDP report would really freak people out and they'd be moving into bonds, but it's not happening. Not yet. Let's give it a couple of hours. And then if this is still the case, I don't think the market is that afraid of that GDP report. And part of that storyline is that for a while we've expected a recession. So it's not like this recession showed up out of nowhere. Oh, we didn't expect any kind of recession. No, the recession talk has been out there for a while. So let's see how the bond market behaves. I think it tells us about what investors are thinking at a very, very high level, a macro level. So that is interesting. All right. So before the market changes, let me just kind of cover the last week in stocks. It's been a good one. This is the 1 week heat map. Meta up almost 11%. That's excellent. Amazon up 8%. Tesla, wow, 22%. Jeez. Palantir, 23%. ServiceNow, 23%. Those are terrific appreciating numbers. Yesterday, we had some stocks on the move. Meta was up. Apple. The software space has really been working. It's been working for a couple weeks now. And I th- I thought that there was really good discounts available on software companies. So I was buying them up. And the software infrastructure play was good. Software applications good. So overall, that's been working. Yesterday, Pfizer did well after their earnings. They really grew their profitability. They grew their earnings per share really well. So investors like that, and they like the 7% dividend. So that looked good. So we'll see where this heat map goes in about 30 minutes. Right now, material stocks are number one. This sector is number one in the market. Utilities, consumer staples. I'm expecting that staples are going to have a good day today. I don't know about materials, but staples is probably going to win the day because people are going to be moving out of growth stocks, technology, consumer discretionary, and moving into staples. Especially discretionary is going to get hammered today. But we'll see. We'll see where the data goes. So lots of earnings. Geez, huge ones. So I'm looking at this is yesterday, and for the stocks that closed, I wanted to make sure we looked at Visa, and I want to look at Booking, and then today. Today, after the close, Microsoft. After the close, Meta. After the close, Qualcomm. For now, Caterpillar. This one is interesting. It tells us a lot about big ticket price, economy. You don't buy a Caterpillar for $10. You buy it for like $500,000. This equipment is expensive. So I wanted to look at that. I think it tells us a lot. I think that's the big one that I want to look at this point. Okay. So I think I've got enough stocks to work with. And Kiter, Starbucks. Now, I've not looked at Starbucks. Let's take a look at Starbucks. But I did hear that they were getting hammered, that their performance was terrible. Let's see if what I heard is what's going on. Yep, down 10%. And, the Starbucks story, they hired this CEO and the stock just took off. And I got lucky on this stock. I bought it like back here. I thought it was discounted. It popped up and I forgot if I sold it here or I sold it here, but I got out and I made a good gain, like 30%, like in a month. And I'm like, okay, I'm good. Ring the cash register. I'm out. And the reason for it is, you know, Warren Buffett is quoted as saying that does he buy into stocks because of the management team? The answer is no. He doesn't buy a company because of the management team. He believes that a valuable business is a valuable business, and that holds true. And to give you an example, Let's pick a CEO that we think is awesome. Let's go with Tim Cook. Tim Cook took over Apple. Apple's a terrific business. And we think Tim Cook's a great CEO. All right, awesome. Let's have him take over a discount retailer. Is he going to make that a $1 trillion market cap company? No, it's just inherently a discount retailer stock is maybe worth $1 billion, $5 billion. And that's where it's going to be. I don't care if you put Tim Cook there and he does a great job, grows their revenues a little bit. It's just not going to change the value of that business. Back to Starbucks. They hired a superstar CEO. It temporarily worked. But what do you have now? You have a market that's pretty much disappointed with the results of the company, and you have a superstar CEO. And he's had time to make an impact on the business. There's no excuse anymore. There's no excuse. There's no, hey, well, you got to give him, a more time. No, he's had 2 solid quarters. He came in as like, hey, you're supposed to be kind of a quick serve industry, superstar. And this is not superstar performance. Okay. So now where's Starbucks going to go? I think I have a valuation for him, so I'll go there next. But I want to take a peek at where a couple of things landed for Starbucks. So revenue did grow a little bit, but I would expect that, if they can get back to 10, 20, 10% growth, then this CEO is a superstar. I would tip my hat to him and say, this guy got it done. But so far, he has not. And when we look at free cash flow, negative, what the heck's going on? So negative cash in the most recent quarter. Margins went down. This is bad. 2 bads. Revenue was good. So that's one good. Now it's okay. I should say it's kind of between okay and good. When you're coming off of 4 quarters of declining sales and you have a positive number, okay. It's like, okay, we're in the right direction. So we got declining free cash flow. If we look at the trailing 12 months, we have cash flow it is declining. See, and you look at these businesses, I don't like seeing numbers where 2019 their cash flow is 3.2 billion and 2024 their cash flow is 3.3 billion. The point that I'm making is it didn't grow very much. An awesome business, a great business would have gone from 3 to 10, like just see it kind of rise. And this one didn't. It's actually contracting. So 2.7 billion. Let me take a peek to see if I have Starbucks. Yeah, got it. And these numbers are going to be too high because the free cash flow is down. So let's adjust this. And it was 2763. And I don't think I've got something working right. And I'm going to move this up to 8% because they're worrying me. Growth rate, no, it's not going to grow at 8%. I'm going to change that to 5. Change this to 3.5. So, all right. So we changed I'm going trailing 12 months times growth. Okay, good. And we've got cash. I wonder if they reported cash. And you see how these numbers really turn negative because the growth rate changed. They can't grow. I can't grow their free cash flows. Their free cash flows contracted. Okay, that's a problem. So Starbucks is overpriced, and I'm going to try to get to their cash and debt level, and then we can kind of finish off this. The cash flow, intrinsic value, valuation, and then we'll look at earnings per share. So cash is 3 billion. And then debt. Ooh, debt went up. Not good. That's not good. They're spending a lot of CapEx likely, and they're borrowing money. Not good. So this thing's priced a little too high. Let me finish off by looking at the most updated. So 23 analysts cover this stock, and in general, they believe the earnings per share is going to be $2.98. And I think that number really impacted the market. This business is not growing. So I'm going to go with an 18 PE. And they are supposed to grow nicely in the future. Hopefully they do. So this one's just a sell all day long. It is not looking good, which is why the stock is selling off really, really, really bad. So that's Starbucks. I'm glad I got out of it. And it was a good move to buy it here because things at that time were looking bleak. We weren't growing the revenue. They were pretty much, a dog stock. People just didn't like them. And then I was lucky. I had no idea they were going to hire a CEO, and I didn't think it was going to create this kind of rally. But once the rally was in, I was like, okay, take the money and run. It achieved the investing goal that I had on the stock. I'm out, and I'm glad because I didn't have my money caught up into the sell-off that is going to happen. And I think about the economy, right? Is the economy going to help or hurt Starbucks? Well, if we're going into a recession and people are, a little bit tight on money, I don't think people are going to be going to Starbucks and spending $5 on a coffee, maybe even $10. Now, I like going to Starbucks, especially with my wife. She has a special drink for her. Not a special drink, just a drink. And I have black coffee. I have black coffee or I have double espressos. That's what I do. That's how I roll. But my wife has a chai with vanilla and almond milk. And I think it's a $6 drink. My drink's $3. So we get out of there for $10. We have a cup of coffee. It's worth it. But at home, if I go use my Keurig, I don't know, I'm into it 25 cents to 50 cents. Well, being the financial guy that I am, there's ROI in using that Keurig. If I just use my Keurig, which I did this morning, I'm in it for maybe 50 cents. And that's far less than $3 at Starbucks. And the commute's a lot easier for me to go to the kitchen and go to the Keurig machine. So Starbucks, I think, is going to have a headwind with the economy. So it looks like Daryl is in. Good to see you, Daryl. And Starbucks has been a sell for you for a while. I totally get it. Yeah, so that's Starbucks. All right, so I see more comments. And Android PC, you sold your Starbucks some time ago. Cool. Anthony, you want to look at STRL. Glad to do it. STRL. We'll look at that stock next. And I caught up with Daryl. No milk. That's right. Now, I got to confess, sometimes, like my second cup, I might go with some milk. And especially if I'm eating something with drinking my coffee, the milk does make it taste different. Man, then Shadow Guys going pro on the coffee making here. You started to roast your own beans? Wow. Nice. So for a long time, I used to grind beans and use a cone filter. And, I'm a coffee aficionado. Now, once I got a Keurig, geez, Keurig made me so damn lazy when it comes to coffee. And it makes a decent cup of coffee, a good cup of coffee. And it's kind of like the AI of coffee. You just put a pod there. You find your favorite pods, boom, pop it in there. A few minutes later, you have a really nice cup of coffee. The cleanup is easier. It's a really really nice system. So Keurig, and I think there's a couple brands that do the same thing, but Keurig's the one we have in our kitchen. One thing I've been thinking about doing is I do enjoy espresso, and I was thinking of getting an espresso machine, but that one, I don't know about the ROI on an espresso machine. I think you spend quite a bit on the equipment. How often would I use it? So I'll have to run a discounted free cash flow calculation on the espresso machine. The Keurig already has great ROI. It saved me a lot of money on as opposed to going to Starbucks. All right. Yeah, if I bought an espresso machine, these tariffs are going to make it a lot more expensive because I don't think we make espresso machines in the U.S. We make a lot of awesome stuff, but the espresso machine has probably come from China, so I'll pay more. See, the ROI is getting harder on buying a new espresso machine. All right, so let's get to the stock that was requested, STRL. STRL. Sterling Infrastructure, and the market has opened. This one's down 3.5, but I wouldn't read too much into that because the whole market's selling off. Sterling Infrastructure engages in the provision of e-infrastructure, transportation, and building solutions in the United States. It operates through three segments: e-infrastructure solutions, transportation solutions, building solutions. Okay. So this is engineering construction. So they're building probably data centers, and then they're doing infrastructure probably for governments. Okay. And over the year to date, this one's down 14.5. Over the past year, it's up 36. Wow, look at that. 5-year, 1.36%. It's done fantastic. And it's probably because it's building out a lot of data centers. Its market cap's 4.38 billion, revenue is 2.12 billion, and PE is 18. Now, this is engineering construction. The PEs are usually really low, so they're not high. Analysts think it's a strong buy, discounted 28%. You see the growth rate here. Now, the growth rate, especially in the most recent year, is not like off the charts. And one trend that I've heard is there is going to be a data center slowdown. Multiple companies, Microsoft has said that, hey, we're not going to build as fast as we first thought. We're going to probably lease some space and then try to maintain our flexibility. And some other companies have come out with the same type of sentiment. DeepSeek came out and showed that, hey, you can do large language models at a fraction of the cost that OpenAI, did it. And you could also do all the other AI aspects with less infrastructure, which means data centers are not going to be as big as once thought if you can become more efficient. And FYI, that's natural in technology. Technology over time, technology gets better, faster, quicker, higher performing, and it gets cheaper. That's the normal trend. It's not like gold where over time it goes up in value. No. Technology over time, compute goes down in cost. It's a commodity. In data centers, the land I could understand could appreciate because it's It's valuable, but the actual compute goes down. So we'll see how things play out. But you could see that for Sterling, the revenues really come down to 2.65%. So the whole slowdown in data center, this doesn't conclude it, but it aligns, or it kind of makes sense that what I'm hearing from stories is showing up in the data, because these guys are slowing down their growth. When we look at their profitability and free cash flow looks good. $416 million, and it's grown nicely. Remember how I complained about Starbucks that, hey, you got to show growth in your free cash flow, and these guys certainly did. Beautiful numbers, nice growth. Margin is construction company, and their margins did expand. Nicely done. Profitability expanded. Nicely done. It might be that they did construction and are maybe offering some services now, some maintenance services. I don't know their business very well, but their margins expanded really well. So from a fundamental analysis perspective, they're doing something right. All right, so 416, they're a growing business. So I would say I would maybe go 15 times that number and minus debt. So let's see if they have debt. So they don't. They have net cash. Very good. So these guys are worth like 6.5 billion, and they're priced at a market cap of 4 billion. So there is an available discount on these guys. Let me take a look at their website. So Sterling Infrastructure, they're in Texas. So E-Infrastructure Solutions, Building Solutions, Transportation. And bear with me, I'm just trying to get familiar with this company. So they do next generation manufacturing, data centers, e-commerce distribution centers. And so that's the right place to be. They're doing the right things. Transportation, that's always been a place where, we need to continue to improve our transportation, but that usually goes where, the government can spend. And right now, the government's like pulling back, right? They're trying to save money. So I don't know that transportation is going to get a whole lot of support. And then building solutions. Okay, so the hottest part. So these guys are doing residential. They do concrete foundations for single family and multifamily homes, parking structures, elevated slabs. Okay. So this is where the company is probably getting most of its growth, is in data centers, e-commerce, distribution centers, and so forth, and manufacturing. All right, so I got a sense of the business. Now let's do a valuation for Sterling Infrastructure. Since it is kind of high level, back of the napkin, kind of, it does price out quite well. So I'm going to start a new evaluation for these guys. I'm going to open up this information on another screen that you guys can't see, so I can start working on the model, and we can do a valuation on this guy. All right, so I don't have I don't have any construction companies that I've valued in a while. So let me see if I can find a similar manufacturing-like company. These are all healthcare companies. Disney, Coinbase. Jeez. Anything similar? I guess I'm gonna go with 3M. They kind of manufacture. So, all right. So we'll go with 3M. And if you're looking, like, if you see how I do discounted free cash flow valuations and discounting a stock from earnings per share, we're about to do one from scratch. So you could see each step of the process as I go through it. And we are about to do that with this company. I had never heard of this company. We're going to see the numbers. Kind of, this business makes sense to me, so I'm good with the business. Today's date is the 30th, and we are filming on the 30th. Okay. Now, this is a smaller construction company, and I'm going to go 8.5% on the discount rate. I'm going to come back to that number in a bit. The symbol is STRL, and that is Sterling Infrastructure. Okay. And so the growth rate of 5%. Let me look at their numbers. So they have grown free cash flow quite well. They're expanding their margins really well. Now, from 2023 to 2024, their free cash flow didn't go up very much. It only went up $2 million. So I'm going to go with 5%. I think 5% is fine. And then 3.5% is fine as well. These are kind of typical slow growth company kind of numbers. And I want to take a conservative approach on this company. Now, what I'm going to do is I'm going to go their 2024 number. And I'm going to add the growth. So their 2024 number was 416.15. And then this will grow by 5%. Okay. So the free cash flow, if they can maintain that cash flow, the company's worth a lot more because they just have good cash flow. And again, I'm impressed that they grew their profitability and their margins expanded. That means that they're digging into business that is worth having. So let me take a look at their cash balance and their debt. So cash is 664.20, and then debt is 369. So 50% discount. If we look at the cash flow, and if we want to be more conservative, let's say we said, well, they're not going to grow their cash flow. It's still discounted. So it's discounted nicely. I think data centers are going to continue to get built. And I think that most definitely e-commerce warehousing is going to get built. We may see that this tariff era may be, I don't know what's going to happen there, because if inventories are depleted, that means warehouses are going to be in less demand. Where my head was going was, I think whoever bought ahead, like bought inventory to load up their inventory, knowing that tariffs were coming, they probably had their warehouses full of inventory. But what's going to happen going forward? They're going to deplete that inventory and kind of not reorder product until they're probably hoping these tariffs get resolved before they can reorder from foreign sources. So that might deplete inventories. So I'm not sure what's going to happen there. But I think data centers are going to be built. All right, let's take a look at earnings per share and update that section of the valuation to see where we're at. Now, how many analysts cover this stock? Only one analyst. Oh man. So it's expected they're going to do $7.43. PE of, I'm going to go with a P of 12. Then the growth rate of 7. Okay. And in general, you see how this number is primarily, this is 66% of the valuation. This is 33% of the valuation. So it's discounted by 36%. Now, it wouldn't be a buy for me because I'm too nervous about how a recession is going to affect the e-commerce business. Are they going to need the warehousing, more warehousing or less? I don't know. That one's kind of a big question. And data center, we've already seen some stories that, hey, maybe data centers were being built too fast, and maybe they're still going to need them. I'd need to do my homework there. It looks good, but I need to do more homework. So I can't give you an opinion of one way or the other, but I would say that it looks interesting. And I don't own any engineering construction companies. So the one thing I would say, engineering construction tends to have um, a a very cyclical graph. Like it goes up for a couple years and then it drops, and you have to buy at the right times. So that's another thing that's going on in my head is the best behind Sterling Infrastructure. Is the stock now going to come down and nobody's going to want to buy it because the stories around the economy, the stories around data center are not helping it. So that's the other thing I have to guard against. So for now, it's just going to be a watch. I'm going to look at it. I'm going to consider it, but I wouldn't be a buyer just yet. Let me just put a placeholder to come back and add it to my watch list, and we'll move on. But thanks for bringing this one up. This one was a good one. And I haven't looked at a construction company in a long time. And most definitely, this one was a super winner. When you look at the 5-year, geez, whoever bought here is really happy with the stock. So it's down 3%, but the whole market's down. NASDAQ's down 2.5%. S&P is down 1.94. Dow Jones is down. Let's take a look at the heat map. All right, so Amazon's down, Tesla's down, Nvidia. Man, all the big cap stocks are taking it. And looks like healthcare is kind of holding on. Consumer staples, I would have expected this would have done far better. I would have expected that these stocks would be doing far better, but they're not. Interesting. It's expected that energy's really taken a hit because oil prices dropped and telecom is up. This is pretty much, nobody's going to cut their phone bill. I mean, they're not going to discontinue their phone service. They're going to continue it. Let's take a look at the markets real quick. The bond market. What's going on here? So we're seeing intermediate bonds, investors buying those bonds and therefore driving down interest rates. Do I have that wrong? See, interest rates are dropping. So they're selling off intermediate bonds and interest rates are dropping. So for me, it's a good day to buy intermediate bonds. I'm probably going to buy into a bond that I've been buying that fits this description. The long-term bonds slightly lower in price because they've gone up and the interest rate's gone up. Okay. So no big move here. I expected a big move here, and I'm not getting it because you're seeing a big move in stocks. And when we look at the NASDAQ, Super early. We'll see where this thing goes. Let's take a look at some of the earnings that have come out and see how they're performing and see if that's going to be kind of a positive influence on where the market overall is going to go. All right, so we looked at this one. We're good there. Visa down 1.27. They announced yesterday, and Visa is really solid. I mean, 22% rate of return. Stock price has doubled over the 5-year. And this tends to be a really smooth, smooth growing company. So that looks good. They had one bad year, and that's COVID related, where the whole economy had a big contraction, understandably. And then looking at their free cash flow, see how their cash flow has grown over time. That's why these guys are so valuable, is they've shown a consistent ability to grow their cash flows, grow their revenues, the gross margin, because they are just providing a service. They have a network, and people use the network and use it for credit cards. So that looks good. I've always valued, Visa, and it's priced quite expensively, 32 PE, and it's a 10% grower. So it's not like, you can buy Google and it's growing better at 17 PE. So why would I buy Visa? It's just a slow grower. But investors that have, they've done well. So that's what's going on with the PE. The market cap's really high, $657 billion and 37 billion in revenue. So you're paying more than 10 times revenue. You're paying almost 20 times, but actually about 18, 19 times revenue, which is high. You're paying that amount, and they're not like growing 30, 40%. They're growing 10%. What makes them really desirable is they are very consistent, and just about everybody has a Visa card. You know what Visa does. You know their business. You know they're involved in transactions. Some headwinds that are going to keep their company from performing really well going forward is going to be the economy. We just showed that we just had a contraction in the first quarter. So is that going to slow spend down? In a recession, their growth is going to, or I should say the revenue is going to contract. So that's what's going on there. So Visa is down as a company, and I think the stock always seems to be priced at a premium and not the right investment for me. So that's Visa. Looks like I'm a little behind on comments. Let me go back to comments and see what we got. So it looks like back to Sterling. You've done some research there. Good. That looks good. But, management teams, you got to be careful. Management teams for companies, they're paid to sell the stock. They don't come out and say, "Oh, things are bad," and the stock sells off. They're paid to, phrase things in a way where things are good, and you'll never hear like a CEO's, say, "Oh yeah, our business is really going to struggle over the next 3 years." They most definitely always have challenges that they have to meet, and they'll always voice. I think from a perspective of optimism. So that's the one thing I would be careful with. Cool. All right. Yeah, if you had a pullback on Sterling, maybe that might make it a little more attractive. And then personally, you sold your Costco. Wow, that's a big move, man. Costco's also been a really, really consistent player. Cool. Good stuff. Thanks, Anthony. All right. So that's Visa. The other company I wanted to take a peek at is Booking. Booking is in the travel space. And airlines have said, hey, the domestic travel is going down, international travel is going down. So that kind of tells us that, hey, maybe travel is going to be going down. So I'm concerned about my Airbnb stock. Airbnb, I think, announces tomorrow, and booking. Um, see how this CEO is paid to sell the stock. At the end of the day, people will always travel. That to me tells me that, hey, he was probably asked a question where it's like, hey, the airlines are saying that, you know, people are not traveling as often domestically and internationally. What's going to happen to your business? And he kind of, you know, turns the question around and says, hey, people are always going to want to travel. Yeah, they're always going to want to do it. Doesn't mean they're always going to do it. Like, hey, I would love to travel full time and travel a year in Europe, but things keep me from doing that. One of them is, I've got two sons that are here back home, and I really like spending time with them as much as they are willing to spend time with me. We have family in the area, and then, obviously there's a cost element that, yeah, I could probably pull it off and travel full time, but is that really what I want to do? So this guy's trying to spin the situation and say, "Oh, no, things are better than people are perceiving." The stock's doing really well. Booking has outperformed Airbnb. I'm an Airbnb stockholder, and they've outperformed Airbnb, I think, in the 1 year and the 5 years. So this has been a really good stock. But as with most stocks, right? It's not like they're the only one. For the last couple months, the situation hasn't been as good. But man, it being just down 3% kind of feels a little bit like a victory for Booking. So that looks okay. The PE isn't bad. And I wonder if I have Booking as a valuation. I'll take a look in a bit. So the PE, if they're growing, so 10% grower, and they do have the most recent numbers. See how their growth is slowing down, and it isn't like, so the Q1 isn't a high travel quarter, right? You have in the northern hemisphere, you have winter, and people are not big travelers in the first quarter. Like, is there a big holiday that they're going to be traveling for? Nope. Um, it's summertime when everyone wants to travel. So um, the contraction, or I should say, the slowing of growth could be a tell that, hey, people are going to begin to slow down their spend on travel. The airlines are telling us that. And then we've got free cash flow. It's excellent. So that looks good. So the numbers are solid. Decent growth, good cash flow. And the reason that I liked Airbnb more than Booking is Airbnb was born in the new era of short-term private rentals, and I think that market is kind of like Uber. It's kind of like a sharing economy company, where Booking really was born in the previous generation. Booking is a merger of, I think it was Priceline and Booking. And Booking was founded in, I think, the Netherlands, and they they did both hotel. You can find a place to stay, hotel, car rental. Kind of like Expedia or Book Priceline or whatever, Kayak, and so that was previous generation. But the new generation is, kind of like Airbnb. Like, they're a pure play private rental, and I think that model is going to have better growth. It's going to be more organic growth. It's going to be, hey, they're expanding the addressable market, because what they're tapping into is all these privately owned, apartments, villas, units that they have on their property. I love traveling on Airbnb. I've traveled the world. I've traveled the US. I enjoy the experience. So Booking is kind of a mix of old school, new school, where Airbnb is all new school. So, but the stock's really done well. They've performed really well. And So long as the travel industry doesn't collapse and kind of really come down, the stock's going to be all right. And they're just having a bad day, but everybody's having a bad day today. So that's booking. And their revenue growth was pretty decent. I'm curious to see how Airbnb is going to do. Moving on to Caterpillar, and crazy to hear the Fed say 60%. Yeah, I mean, we've heard of this recession for a while, and looking at that first quarter contraction in the GDP, I agree with 60%. Uh, I would say it's 70%. Like we're halfway there, and we have momentum into a contraction. We have tariffs that are, concerning all these decision makers at companies. Who is buying ahead their inventory while you're being charged a big tariff? I don't think anybody's doing that. So that's off the table. So you're not going to grow from there. And then big spend, right? Let's say you had thought, hey, we're going to start a project, maybe to build out some big, high rise, building for, let's say, residential. And you're like, whoa, hold on a second. Tariffs are going to add how much cost to our building? It's going to add 10, 20%. Whoa, there goes there goes a big part of our profit. Let's hold off. And holding off on a infrastructure project like that, or a big construction project, or some type of expansion, it really adds up, and it's going to hold back the economy until we get, if we get tariffs off the table quickly, like in the month of May, maybe we avoid the risk of the recession. If we're in tariffs through the whole second quarter, which is April, May, June, I think we're going to officially stamp 2025 as a recession year. I just looking at it kind of high level, that's what's in the cards. So hopefully the report on the GDP is a big motivator for the tariff issues to be resolved, and like, hey, let's get those things off the table because they're gonna hurt the economy, and we're already first quarter is in a recession. So let's get moving on making the economy grow. All right. So Caterpillar is a huge infrastructure play, right? They sell big stuff. They sell both big equipment for construction, mining, and I believe they do agriculture. They're not listing it here, but you guys know what these guys do. Big, heavy equipment. So it goes back to, if the economy is booming, Caterpillar's doing great. Now, I happen to think that Caterpillar is going to be captive to tariffs, because I know that the Japanese are heavy equipment manufacturers, the Chinese are heavy equipment manufacturers, and we are heavy equipment manufacturers. Our equipment's really good. Well, if they start charging a tariff on Caterpillar or Deere equipment, we're going to see these companies not sell as much internationally, and that's a problem. We'll be consuming it domestically. Okay, that's fine, but that could be a problem for them. So these guys, Caterpillar. So you see how they're saying that there's cost due to the tariffs, and they expect negative economic growth in the second half of the year. Okay, so they're going to contract in the second half. Even having said that, they're only down 0.25. I would have thought they would have been hammered. This has been a winner because during COVID, this stock really came down. And then it came off of, we're comparing to really low numbers that we were coming out of COVID. For the 1 year, it's down 10.7. You have a 2% dividend. Not bad. Not bad considering that, we have had a bad year in 2025. Year to date, 15, right there with all stocks. That's pretty much keeping up with the Dow and the Nasdaq. So Caterpillar, 147 billion-dollar market cap. This has always been kind of just a solid company. I haven't found a reason to buy them or the right situation to buy them. And I think as we see, like, right, investing at the right price is always a good idea. And if I could see this stock really sell off, I would totally be a buyer. And I'm going to keep my eye on CAT and see when would be a good idea, because I think the news is going to continue to get bad around recession, tariffs, doom and gloom. Oh man, things are bad. And that's a good time to use the fear to our advantage and start buying early into CAT and other companies that once things turn, boom, we're going to see um, things get much, much better. So um, I'm going to keep my eye on CAT and see when would be a good time to buy into Caterpillar and as well as other companies. So interesting that they haven't sold off the whole lot. I think a lot of people like this brand. They like being investors in CAT. Not a lot of people are selling. Novartis is up a little bit. The healthcare space is up. These guys announced yesterday. Novartis is a winner this year. Man, that looks good. This company is getting it done. Nice big dividend, big market cap, and growth rate is there. Really nice, consistent growth rate. The quarterly looks fine. And let's take a look at cash flow. Free cash flow looks really good. See how they're expanding it? Looks really good. So this one here, do I have a valuation on this one? So this is Novartis. So one of the companies that surprised me was Pfizer. I didn't like that they had their revenue contract in the quarter. They had 2 really good quarters and then a bad quarter. And I'm like, okay, I don't like that contraction. So let me see if I have a valuation on Novartis. And I don't. Okay. So I'm gonna do the evaluation on these guys later, and compare them to Pfizer. So it's good to see there is some green out there on a bad day. What's Pfizer doing? Pfizer's up again. So they've had a nice little run here. That looks good. But what I did not like is that they contracted in the first quarter. They had something going here and then contraction. It's like, what the heck? Where'd that come from? So that's my biggest problem with Pfizer. But good to see the stock is up. They did expand their earnings per share. They grew their earnings really, really well. So that is Pfizer. S&P, really smooth company. They just go up over time. Over the 1 year, 17, 65%. We looked at this one in the member call. It does have a high PE. They announced yesterday. Forward PE looks a little better, but they are expensive. And I think this run up here, it's kind of like all the good news is priced into the stock. And it may not do great going forward. It's doing okay in 2025. Just seems a little expensive when I look at it. All right. So we got Honeywell. Honeywell did do well yesterday, and they announced before the market opened. Now they're down, understandably. You got a bad economic report, and they're selling off. But this one here, PE of 23, forward P of 19. Looks pretty reasonable. They have been growing, not big growth. This is single digit, and it's just such a it's it's a very well-known business. It's been around for a long time. The quarterly revenue looks good. The growth almost 8%. But I think they are going to struggle to grow if we have a contraction, because people are going to, these guys are going to grow when you see either new construction or remodels, and you know the the maintenance work is going to keep the revenue flowing, but their growth is going to be based on new construction, remodels, and stuff like that. So I don't know if there's going to be much of that. So that is Honeywell. So you want to talk about Spotify? Perfect. Let's look at Spotify. So Spotify was down yesterday, and now it's up. Interesting. So they announced before the market opened. The market didn't like what they saw, but let me take a look at that, because I think this stock had a lot of movement. Spotify is going to be expensive. I'll tell you that much. So this is what the stock did. They announced, boom, came down 10%, but then it clawed its way back. And really, from the time they announced to the time the market closed, they were down only 3%. And now the stock is up 3%. So we're back to even. Now, I'm a fan of Spotify. Over the 1 year, it's up 100%. Over the 5 year, 330%. And my problem with this stock is this is not like a value investor like stock. Everybody knows what Spotify does. And I'm a customer, I'm a subscriber, I'm a paid subscriber of Spotify. And I have turned off my paid service, and I'm thinking of doing it again because I just don't use it all that often. And I have so many access points. Like I can listen to music on YouTube, I can listen to it on Spotify, I can listen to it on Amazon. And I like the Spotify service most, but I'm paying for it. And it's like, well, I'm not sure that it's worth it anymore. Now, the growth of the company, real good growth. It continues to grow. $16 billion in revenue. Quarterly growth continues. So that looks good. And they are like the dominant within music streaming. And their service is, I think, the best. It really is, for me, my favorite way of listening to music. Other businesses have tried to come in, Apple, even YouTube, but they just can't. They can't get this player out of the number one spot. Market cap 121 billion. When we compare that to their free cash flow number, free cash flow is $22.6 billion. So their cash flow has been growing. That looks good. So to get to their valuation, you'd have to multiply this times 40. Now, I'm not ready to do that. It's like, wow, that's a big multiple. I could do 20 to 30, and that gets us to like 75 billion. And we're short of that number by a pretty good margin. So this stock's always priced at a premium. And a part of what makes this stock go up is the average investor and retail investors. And even when I listen to some of these professional investors, they're kind of momentum traders. They're saying, hey, the Spotify business is growing, they're doing really well, hey, I'm going to buy into it because it's setting up really well. And that's how they invest. And if they make money, awesome, good for you. I don't invest that way. I want a really nice discount, and I don't get a discount on Spotify. So I've never bought Spotify, and it's still priced at a premium. Netflix is a similar story. I bought into Netflix, made money, and got out. And when you look at, I think if I want streaming, I'll buy into and I already own Alphabet, which owns YouTube. That's the dominant streaming service on the planet. It's growing faster than Netflix. It has bigger audiences than Netflix. It has a model that is going to break Netflix because Netflix has to pay for their content. YouTube doesn't. It's a big difference. Like YouTube does not need to risk capital to create the next great show. And Netflix does. They have to risk billions to try to get the next cool show. And if they don't pull it off, that's a bad, return on investment. And Spotify doesn't have to risk their capital either. They do. They were buying into podcasts, and they were paying famous people money to create podcasts. And I think they're slowing that down. So I'm in the streaming business through Alphabet and through Amazon. Amazon also, they have their Amazon Video, Prime Video, and I think that's a great service. And they kind of integrated into their Prime membership. That's good for me. That's enough TV for me. I can't consume anymore. And I'm beginning to feel that way about music, but we'll see. I'm probably going to hold on to Spotify a little while longer and see if I want to cut that subscription down a little bit. But this business is really popular. The stock price can't argue with an appreciation rate of that amount. And then over 5 years, it's done really well. So people that really believed in the company were rewarded $71 up to $590. So Spotify. Yeah, and Google Alphabet, and I looked at good graphs yesterday. If you compare, so let's go to Meta AI. I don't know if you guys saw that Meta AI, Meta announced that they are putting the next area of massive investment for Meta is going to be AI, and they want to compete against OpenAI. And this is what they want to compete with. So I'm going to ask Meta AI, compare subscriber growth Let's see what Meta AI can do for us here. So Netflix had in 2024 260 million subscribers, and YouTube has 2 billion. That's a lot. So you think about all the advertising that comes along with that. Huge. This didn't give me a great report. It just kind of gave me a lot of good information, but so you see the scale difference, just huge. YouTube is so big, and most of you are watching me on YouTube. And I think once you have all the eyeballs, you can do a lot with it. And that's what Google did with search. Is at the beginning, search wasn't monetized, but once they got everybody to use Google search, they figured out how to monetize it. Once they had everybody going to Google search, then they did some with it. They have 2 billion monthly active users on YouTube. Wow. Incredible. So that's why I buy into Alphabet versus Netflix. So Spotify, I tip my hat to investors, but it's just not the right investment for me. I'm going to stay in my lane and keep making money by buying stocks that are discounted and finding those discounts. And when I have the combination of I believe in the business and I'm getting a discount, perfect. American Tower, this is a REIT, and I thought I'd put it out there because these guys are just going to keep doing well. And I have a really good REIT, CTRE, but I'm thinking of switching horses. Um, some of these other REITs have done better. This one is up for the year, down for the 5 year. Isn't that interesting? PE is really high. Forward PE is 32. So this one's not looking great. The PE is too high, but they're having a good day. Year to date, it stocks up nicely. I think because their REITs have done okay in 2025, and they are helping with the whole, smartphone communication. That's where these guys operate. So it looks good. And they're having a good day. All right. So looking at the heat map, and we've got still a lot of red. We've got Meta's down. That one's going to hurt. Amazon's down. Google's down. A lot of red. Healthcare is just, not green, but it's not, that brilliant red. Got a couple of stocks that are doing okay. CVS is doing okay. Pfizer's doing okay. I'm surprised Staples are not doing better than that. But it looks like probably the best space is these telecom services companies. They're doing okay. Looks like they're very defensive. All right, so the Nasdaq's down, but not down as much as it was earlier. So that's interesting. S&P is down. What's the S&P done for the day? Yeah, it's kind of picked itself up. It was down even worse. So let's see what happens. The earnings later today from Microsoft and Meta and even Qualcomm could move the market. So we'll see where the things go. You're right about that, Anthony, that people are focused on, subscriber growth. I get that. Yeah. And that's what makes them buy into the stock. Hey, you keep growing your subscriber growth, which is one thing. But at the end of the day, where I like to follow the money, which is cash flow and earnings. And, if you grew your user counts like, you're doing it in a way where it doesn't mean anything. There's no profit behind it. Well, I don't really care. It's like grow your subscribers, but doesn't mean anything from a dollar perspective. So I'm not going to be a buyer. So yeah, so we'll see how things play out. I'm expecting, and I know it's like a contrarian, thought, but I think that Netflix is going to have a very solid correction. I think this stock is going to come down to like $600 per share. It's at 1,100. When you study their fundamentals, like the amount of money they're making, the cash flow, and so forth, it's way overpriced. And at some point, that will matter. And it's my expectation that they're going to come back down to 600. And Spotify is not quite as bad as Netflix from an overpriced perspective, but I think it's similar. And we'll see. We'll see if I'm right or wrong, but that's my expectation based on fundamental analysis. All right, so we've got a market that's selling off. We looked at some big earnings. One stock that I didn't look at was PayPal. Let's take a look at that. So PayPal had a good day yesterday. It's having a bad day today. Everybody's having a bad day. It's had a bad year so far, 2025. It's heavily discounted. I like the proposition PayPal because you're getting a low PE and you're getting a discounted company. It's a growing business. That looks good. And the revenue is really, really good. Almost 32 billion. Free cash flow looks great. Almost 6 billion in free cash flow per year. And they're growing it. So when I value PayPal, I get a really nice price, really nice discount. So I've already bought a lot of PayPal, and it is a buy for me, man, because the cash flow of this company is it just continues to grow, looks great. Just the market dislikes PayPal. I don't know. I'm not sure who they upset. And they just have really good discounts. So I'm a buyer of PayPal. I think it's going to do well over time. It has done really well historically, and it just has had a period of time where investors just don't want to be a part of it. But during its heyday, it was a $300 stock. And what's interesting is if you compare the company 4 years ago to today, they're bigger. They're bigger in revenue size. They make more money. They make more cash flow. So I can understand the market needed to sell off in 2022, but this one is just overdone. And at some point, I expect this one's going to rise. Remember, I showed you Visa. Visa's $680 billion market cap. These guys have a market cap of 62 billion. And they're in a similar business, right? Visa, I think, has a bigger moat, better competitive advantage. But PayPal is pretty darn big, and they're integrated in so many websites. They have Venmo. They're into cryptocurrencies now with a stable coin. They got a lot of good things going on. Spotify. I think Spot is kind of in the growth phase. Yeah. Let's see how things play out. There's a couple of stocks that I've been proven. My theory has been proven wrong or is just not aligned with reality. Palantir. Palantir is expensive in my book. It continues to be expensive. And Netflix, I've been right on it. I've made money on it. I knew when to buy it. I felt like I knew when to sell it. And it's gone up higher than the price that I sold it at. But there's a couple of stocks out there that, you know what, they defy conventional kind of valuations and they fly up. Okay, cool. Go for it. People can make money on that. And there's members of the channel that are Palantir stockholders. I'm glad for them that they're making money. But I'll always just state like my opinion. I think we should always just state how we see it because we all collectively benefit from hearing somebody else's theory, thesis, logic, explain why they're arriving to that conclusion. There's a lot to be learned. That's what I hear, or that's when I listen to when I hear other investors talk about an investment. And when I hear their logic and stuff, I may not agree with the conclusion that, oh, so-and-so stock is a buy, but I usually learn something. And that's why I like to listen. All right, cool. So I'm going to go ahead and land the plane on the live stream. Really good stream, a lot of stuff going on. The biggest bit of news is this economic report showing that we are headed into a recession unless we can see some growth here in the second quarter. And I think it could happen so long as we get these tariffs off the table. Just get them off the table. Let's start growing, start making, getting our industries to really get up to 100% of their capacity. And we'll see what happens. And that's it for today, guys. Thank you to all the members for your support. We got a new member today. We've had a lot of good members, a lot of new members sign up recently. The members that have been here for a while, thank you so much for being members. I appreciate it very much. We're going to have a member call tonight It's going to be at 8 p.m. Eastern, 5 p.m. Pacific, and we can talk about all the different earnings that come out after the market closes. The big ones being Meta and Microsoft, and talk it through there. I encourage anybody who's not a member, think about being a member. It'd be great to have you. I think the perks are pretty good and worth the dollars you'd be spending on a monthly basis. So thanks so much, and it's good to see you, Eric, over on X. Thanks for joining. Thanks, Anthony, for all the chat, and really enjoyed talking about Spotify with you. Good luck with your investments, and everybody, good luck with your investments today. Let's hunker down. This year is kind of it's going to toughen us up. We've had some pretty substantial sell-offs, and we just got to stick to our long-term plan and our strategy. And I think we can turn this into an opportunity, especially with stocks that have been sold off too much. Buying them at a good price is a good idea. So let's keep working to analyze and find the right companies to buy. Have a good day, everyone, and I will talk to you soon.